Hi, I'm Rob Myers. I'm an agent here at Insurance Services of Zealand Opal. This is my 11th year. One thing I'm going to talk to you about today is annuities. Often when people talk about insurance, you think of health insurance, life insurance, car insurance. But the one thing that doesn't get talked about that's an insurance product is an annuity. Some of you might know what an annuity is. Some of you may not be familiar. Today I'm going to kind of give you a little crash course on what an annuity is and how they work. So annuity is a fixed contract between the insurance company and yourself, the person that buys it. And it requires the company to make payments to either you immediately or after. One thing we're going to talk about is why to consider annuity. And there's lots of reasons why you should consider it. The annuities that we offer here at Insurance Services of Zealand, they offer zero risk, so that you're not going to lose any money. Oftentimes people think, oh, I don't know about an annuity because I might put my money in there and what's going to happen to it. The annuities here that we offer here at Insurance Services offer zero risk. And I'm sure you're aware that the federal government now has raised the interest rates. So while sometimes that's a bad thing, for annuities it's a good thing because it means you're going to be making more money. So larger interest rates equals more money for you, whether it's in your account or you're in your pocket. One thing that I like about annuities, it takes the anxiety away of worrying about your nest egg. A lot of our clientele is on fixed incomes, being of the Medicare population. So, being in the stock market, it kind of leaves an unknown of, what's going to happen to my money. I can't afford to take a big hit if the stock market goes down. How am I going to recover? I have bills to pay. I want to go on a vacation, things like that. So that's another big plus for the annuities. Another one is the interest rates are a lot better on an annuity than on a CD or a savings account. You can Google just about any CD that you can find on Google, or I'm sure the banks give like 0.5% on your savings account, that the money that you have in there now. So you're really not gaining much. So that's another reason why you should consider an annuity. And the last thing that I wanted to mention, most annuities allow you to withdraw during the contract period if needed. For instance, the ones that I often sell myself, of course, I'm not going to use them until I'm of retirement age of 59 and a half. But if I needed the money, most annuities allow you to pull 10% out along with the interest. So in the event that I needed a new roof on my house, or I needed to fix a car, buy a car, depending on how much money I have, I'm allowed to borrow 10% of that, take out 10%, I should say, of that annuity without any penalty. Because people often wonder, what if I need money and, am I going to get penalized for taking money out too early? Most annuities allow you to withdraw 10% plus the interest. Just an example that I'd like to give. I think giving you guys an example is more beneficial than just me talking about the annuity itself. So I made up a guy. We have Jim Marstetti, who has accumulated $600,000 in his 401k. With the uncertainty of the stock market, Jim decides he wants to diversify his portfolio so he's not 100% tied to the stock market. Jim decides to move half of his 401k, which would be $300,000, into a 5-year, multi-year guaranteed annuity. That's what MYGA stands for. It's multi-years, it's guaranteed, and it can never go down. What the rate is what the rate is for the length of the contract. So we have 3-year annuities all the way up to 10 years. This one, I picked one middle of the road. I picked a 5-year. And I used a percentage of what one of the companies is offering right now, which is 3.75. Some of the companies are even up over 4. I've seen as high as 4.3. But we're just going to use this example. So he puts $300,000 in. Everyone wants to know, what am I going to get at the end of 1 year? What's my money going to make me? So at the end he puts $300,000 in. You times that by 3.75. At the end of year 1, he's made $11,250 guaranteed. It doesn't matter what the stock market does, doesn't matter what the economy does. He's got $11,250. You take that $11,250 and you add it to his is his initial deposit. So now he's up to $311,250. On the second year, again, he times that by 3.75. In year 2, he makes $11,671.88. You add that to the first year number. Now he's up to $322,921, and you keep doing that. And as you can see, year by year, it keeps compounding. So by the end of year 5, he's made $360,628.96. So he started off with $300,000, and he ended up with, in just 5 years, he made $60,628.96. So for a 5-year time, for not doing anything, for not having any worry, it's a great product as far as investing with no having to worry about what's going to happen to my money. You know what you're going to get, and you can kind of depending on how much you have to allocate to your retirement, you can kind of gauge how much money you want to leave in the stock market, how much money you want to put. I call it safe money. I'm a big proponent of safe money. I worry too much, so I have a lot of my own funds in annuities, just because I don't want the headache or worry of the markets. I do still have some of it, but it's important to diversify your portfolio. This is just one example too. I have people that immediately put money into the account. So for instance, let's say Jim he said, I don't want to wait the 5 years, I want the interest right off the bat. So he would put the 300 grand in, and with the 3.75%, he would make $11,250. Now, he can choose to get paid over 12 months. So if you take that $11,250 and divide it by 12, because there's 12 months in a year, Jim would get a check for $937.50. So you take what he's getting from Social Security, you add that $937 in, that's a nice big chunk raise. So that's another way you can work the annuity. This example is of qualified money, meaning you're going to have to pay taxes once you withdraw it. I have people that have lazy dollars, we call them, that have non-qualified money. They use it as a savings account, basically. They just put money in it. If they need it at the end of the 5 years, they can take the whole amount out if they want. Other people just say, I'm just going to keep adding to it, and I might leave it for my grandkids, I might leave it for my wife. So there's a lot of avenues you can go down with an annuity. This was, like I said, it's just one example. It's probably the most common example. So any questions on the annuities, you can stop by Insurance Services of Zelia and Opal, give us a call, or call 724-452-2300. Thanks.